Good afternoon, Ms. Jones. It's good to see you. Congratulations on taking your first step in financial planning as an investor. And you picked a good time. October is National Financial Planning Month, so you picked the perfect time to start. Now let's discuss what you're looking to do. From what I understand, you're looking to save $40,000 to use as a down payment on a house within 10 years. Now that's a good goal, and that helps us devise our plan. We have a specific time frame and a specific amount that we're trying to reach. Now we can make the plan to get there. We've already discussed that you have adequate emergency funds in your risk capacity. You have emergency funds, you have a stable job, your risk tolerance is high, so we take that into account as we're devising the plan to help you reach your goal. First, I'd like to explain some of the different vehicles for investing. Bonds, quickly, are loans to a company. You basically loan money to a company, they pay you interest, and you receive the money you loan to them back at the end of the term of the loan. Stocks involve ownership in a company. You basically buy a partial ownership share in the equity of a company, and you share in the company's profits and losses. Mutual funds and exchange traded funds are two different vehicles that basically pool a group of investors' money together in order to buy a wide variety of stocks and or bonds. This process is called diversification, and it lessens the risk involved in investing into a single particular equity or a particular sector of the financial market as well. The allocation would also affect your investing plan, as an allocation determines what percentage of bonds and what percentage of stocks you're holding. Your goal is within 10 years. So the fund that I looked at for you, a mutual fund would be better off for you just because it's better for a low-cost investor. You are diversified, you're spending lower fees, and it's easier to have a professional money manager watch your money. The fund that we're looking at for you is the Vanguard 2025 Target Retirement Fund, and even though it is called a Target Retirement Fund, it's basically a target date fund that's set up for a 10-year time frame, which would work perfectly for you for looking for the down payment on a house. If you go to the Vanguard site, which is where you would go to open up an account as well, it gives you a lot of information not only on each individual fund but on investing in general. But it shows us here that the fund has, over a 10-year period, has averaged 5.65% a year, and since inception in 2003, 6.5%. This fund is actually made up of 4 other Vanguard funds: the Total Stock Market Index Fund, the International Stock Index Fund, the Total Bond Market Fund, and the Total International Bond Fund. The ratio, the allocation, is basically 65% stocks to 35% bonds. And this again diversifies and spreads your money out to lessen the risk involved. For your goal, we're looking to save $40,000 in 10 years. You said you had $1,500 to put in. This fund has a low $1,000 minimum investment. If you invest $1,500 and we expect the rate of return to match the previous 10 years of 5.5%, just to be on the safe side rather than the 6.5%, within 10 years you could reach your goal of $40,000 by putting $235 monthly in, which is well within your budget. So anyway, that's where we stand with that. In order to open an account there, again, you would just go to the website, or that you can call the phone, but I think it's easier through the website. And that's pretty much all you have to do. In order to educate yourself further, though, so you can be happy. Oh, one more thing about the Vanguard 2025 Target Date Fund. One of the things that I really like about it is that as you get closer to the date, closer to the time frame that you're looking to buy your house, the fund manager reallocates the composition of the fund so that you don't even have to do it. It's basically you buy it, you put your money in, you set up on an automatic investment plan to deposit $225 a month, and that's it. They reallocate the money as you get closer to your goal to lessen your equity holdings due to the shorter time frame and raise the bond holdings. And that's basically it. To educate yourself, again, there are a lot of other sites you can go to. CNN Money has a lot of good personal finance, initial investor education. Zacks Finance actually gives a lot of information about individual equities and funds and their recommendations. Morningstar rates all the mutual funds to give you their idea, and then again a lot of information there on the mutual funds in particular. The only caveat I would advise is at sites like Yahoo Finance. A lot of the articles are written to grab attention, and I would use them more for information rather than recommendations from some of the people. And just recently, just to give you an example, there was an article by one analyst who believed gold was going to go to $20,000 an ounce, and you have other recommendations from analysts who believe that the Dow Jones Industrial is going to hit 50,000 within a year. So you have to take it all with a kind of a grain of salt. But anyway, thanks for your time. I know that was a lot, but if you have any questions, I'd be more than happy to answer them now. But thank you.